Welcome to Dream Machine with me, Alex Matcham, and my colleague Laura Brown.
Hello.
Each episode, we're going to speak to one of our fund managers in an attempt to get to know the people behind the portfolios.
That's right. Every episode, we're going to be asking our investment expert what their favourite drink, packet of crisps or chocolate bar is.
As well as some other questions to help to get you to know them a little bit better.
Obviously, we should say this isn't a promotion for any of the items that we're talking about. There is a whole world of snacks out there.
Indeed. As always, none of the content on Dream Machine should be taken as financial advice or nutritional advice. If you are unsure, you should speak to a financial advisor or a nutritionist.
Right, so with those disclaimers well and truly out of the way, let's begin. This episode, we're joined by Richard Woolnough, fund manager on our fixed income team at M&G Investments. Richard's been at M&G for 20 years and has a particular focus on credit. Welcome, Richard, to Dream Machine.
Hello.
So, Richard, how did you react when we asked you to do this podcast?
I was travelling with you on the train, and it's always a good idea to get together and chat. And at M&G, we try to be as transparent and open as we can. So I'm looking forward to the interview.
Excellent. Well, we look forward to hearing your selections in due course.
Perhaps if we start, Richard, with a bit of a kind of understanding of how you entered the world of how did you get into the world of investment? And
I've always had an interest in economics, so I went to university in London School of Economics. Always enjoyed it. The 70s was a time when there wasn't much on television. There was only 3 channels. After children's programs, the news was on. News was full of economics. So I had a very good economics teacher. Enjoyed the subject. And then was living in London and entered the industry.
do you start as on the equity side? Is that right?
I started on the sales side. So Alex often asks me for tips. I started on the sales side. But Alex is a far better salesman than me.
Excellent.
But you did run equity strategies for a period of time.
Yes. So I spent a lot of time doing equities, and it puts us in a slightly different position, especially these days when people get specialised and segmentised early on in their career, not only necessarily by asset class, but part of the asset class, whether it be tech, commodities, growth, value, whatever it might be, or by country or region, or by all of them. Being a generalist is far more interesting, and I think it's far more appropriate to be a bond fund manager where what drives returns changes over time.
And what made you make the shift from equities to bonds? Was it just about opportunities?
It's just a growing market. The bond market in the sterling wasn't really started in, was de minimis in terms of issuance in 87 to 88, 89, and slowly and surely it got bigger and bigger. As the international capital markets developed, then it went from being 10 issuers. You can't have a career when there are 10 issuers and they're all AA and AAA, but slowly and surely the capital markets broadened up. And so you had lots of investment grade issuers, lots of pension fund demand for long dated assets, lots of annuity demand for long dated assets. So the investment universe grew tremendously. Now as the investment universe grew tremendously, then obviously it's a great place to be. And it continues to grow, which is a surprising thing, A number of years on, development of the euro has created a huge European capital market. Global trade has resulted in a huge US capital market. Those things have been a big change. And whether that be before it was governments or quasi-governments, now obviously the debt universe is populated by a great deal of lower investment grade and a great deal of high yield as well. So the universe has changed. I think the big driver over the last 10, 15 years of that has been the banking market. So the banking market used to borrow short and lend long. They're no longer permitted to do that as much as they did before post-financial crisis, when it was shown that borrowing short and lending long could result in liquidity issues. And so that financing has now moved into our marketplace. Like any market, once it gets bigger, it begets more things. And there's a symbiotic relationship. More and more investors come, more and more issuers come. More and more issuers come, more and more investors come.
Should we kick off formal proceedings on the vending machine side? So we're starting off with your dream drink item, Richard.
So what have you gone for, Richard?
I've gone for a Coke original. So a full fat has to be. The there's more value for money, presumably, in the full fat than a not full fat. So yes, I'm. This is what we've gone for. A classic any time of day drink.
Any time of day, really?
So you'd have that any time.
Breakfast.
Breakfast, if need be, yes.
Okay.
Oh, okay.
I tend to have a psychological pre-10 o'clock.
No, but if the situation determines that you need a full fat Coke, there are scenarios.
There are
scenarios.
Yeah, that is true. That is true.
Obviously.
Yeah.
You talked about the more value for money for full fat versus Diet Coke. As a kind of bond investor, I've heard you often describe yourself as a value investor in bonds. Is that something that kind of permeates throughout your life?
Everybody's like that. Everybody tries to find, what's appropriate, what's the appropriate risk reward, what's the appropriate value. So yes, it's something that spend all your time thinking about odds, thinking about what's likely, what's not likely. I spend a lot more time doing it at work where that framework is established than obviously at home.
Right.
So that's the various.
That's reassuring.
But I quite like the idea now that I can apply it to Coke, because I think you're right. Is that actually you're getting probably for a similar price, you're getting more.
Well, we have the same value for discussion on the train again. Go back to train. It's like season ticket, not season ticket.
And what was the conclusion?
It's exhilarating.
We have a different outcome.
Okay, so you're a season ticket and you're a non-season.
I am.
ticket.
Yeah. Rich is much better at that though. Hence my question. So he gets full value. You obviously had a very successful long investment career. What keeps you motivated?
That's the opportunity set. There's usually something to be done, something interesting. There's something that's a challenge in terms of trying to interpret where the markets are priced and where the data is. So it's solving that puzzle. It's solving the puzzle of where, how to invest, where to invest, what's the risk reward. And that's what drives what we do. And it makes us different. It makes us different from people who get up the market, get them in the morning and say, what shall I do? Oh, I'll just rebalance the index. That might be what motivates them, but it's not what motivates me.
And on the flip side, how do you kind of switch off from markets?
I'm quite sensible. So you compartmentalise your day. And so you have a time when you're thinking about work and then times when you're not. Sometimes you might suddenly have an idea when you're away from the office that something's churning away in the back of your head, and then you go and check to see if it makes sense when you return there. So really it's just a function of seeing the broad opportunities out there and keeping an eye on how the data changes. And if there's information that changes your view, you work out if you want to change your view or not, or if price changes, does that change your view? And that's the way we work through it. So we try to think from basics every time. We recognise that the rules of the game keep changing, and as those rules change, then it makes sense to adapt with them.
The only question I was going to ask, and I wasn't sure, was if you're going into the industry today.
Oh, that's a good one.
What do you think you'd end up doing? Like, where would be your areas of interest?
I think it's a very different world.
Yeah.
I think it's become a lot more specialised. A lot more filtering goes on about how people come in.
Mm-hmm.
It's generally a lot more ordered.
Your point about segmentate, like almost everything's in a bucket now.
Yeah.
That creates more, you have to focus more quickly, I suppose, in that.
Yes, I mean, well, it's a strange thing. You might argue become segmented and specialised, you start really early. But you don't get segmentised or specialised till you're really old. So you go for the generalist training, so it's graduate, probably a postgraduate now because a number of people are going to university to get in. Graduate recruitment program, it's 2 years, a round of desks. How old are you going to be before you actually, then you're given a speciality, and then you might work on that for 2 or 3 years before you make a decision. Yeah. So in one way you say, oh, your speciality, that's good, you're starting young, but that speciality is occurring when you're maybe nearer 30,
I see what you mean.
As opposed to when you're nearer 20. So it's a strange change in culture. It's understandable. People are going to education longer, going to university longer. So that's what's happening, and that's working. very well, but it's become a lot more formalised and dominated by large institutions as opposed to entrepreneurial institutions.
Yeah.
And therefore they have to work in a particular way in order for them to work. So I think that's why we're different. And when I look at the people I work with, one thing we always try to do with them on our team is give them responsibility pretty quickly, because then they get used to making decisions and get used to making good decisions and bad decisions, because they go to make both. But if you only ask somebody to do something once in a blue moon, how can you know that they're good, and how can they know that they're good, and how can they learn? So I think it's that sort of trying to get exposure to things. And I know I've not worked anywhere else for a long time, but there definitely is amongst our team a desire for people to make a decision and choose to do something.
Yeah, I don't think I'd have liked that personally.
What?
Having to make a decision. I think we did a lot of rotating around for a long time.
It's going to end up where...
Oh, you're the grad program as well, yeah. Okay.
One of the ironic things is that when I remember you interviewing me, Laura, and when you asked me what I wanted to do, I said anything but sales.
Yes, you did. You know,
it's funny where you end up.
Your dreams came true.
There you go. So look, I think Coke is a very solid option. I'm a fan of a full fat Coke. So yeah, please.
Yeah.
Moving on to our second item, your Dream Crisps, Richard Woolnough.
Well, they go well with Coke. So
this is a complimentary.
It's a sweet.
Portfolio.
Okay, I
And
like
your-
the portfolio. Well-constructed
And your choice
portfolio.
is
Excellent.
salt vinegar.
Salt and vinegar.
Salt vinegar.
Specifically, any particular brand?
Well,
We've got
because
Walkers
they've been
here.
around the longest. Coke's been around the longest. Walkers have been around the longest, as far as I can work out.
This is classic crisp for me.
It's good. It's a good solid
crisp.
It's probably ready salted is just too plain. So this is probably the first ever flavoured crisp, and they got all the Matcham tip and went for salt and vinegar. And they've tried everything since.
Yeah.
But,
Are you a fan of the kind of more exotic?
I tried them, but I think there's a dependable. Go back to where you want to be, which is something like this, and that works very well with a drink of Coke.
I like the fact that you've done complementary items,
Yes,
as opposed to individual things. I like the way that they're going to think about
that
them.
might be a problem with the next item, because it's not really complementary with either of these two. So that's my outlier.
Indeed, but again, I would say, very solid. You can't question salt and vinegar crisp in a Coke, so that's excellent. You talked earlier on about the bond market evolving in your time. We've obviously seen, particularly more recently, the kind of rise of passive investing in particular. How do you respond to that, or how have you responded to that, and do you continue to respond to that?
There's a place of passive investing. How appropriate it is for different asset classes is a question. How appropriate it is for equities, for bonds. The ultimate passive investing is just putting your money in a bank account. It's all pretty passive. And the question is, when you decide to not be passive, you still have to make a choice. Do you want to buy something that tracks something? Well, what you can decide to track. That's a big decision. So that's not passive. It's very, very hard to see a truly passive investment. It might be described as passive, but deciding to buy it is an action. Only purely passive investment, obviously, is cash, where you just do nothing. You just leave it in your back pocket and do nothing with it. That's passive. So once you start doing something else, you've made that decision. And that decision, it could be appropriate to do it through a passive way. It could be appropriate to do it in an active way. It's a question if you want to make active decisions. If you took a world where an individual is completely passive, they never have an investment. If you took a world where they're completely active, they do it all themselves. Nobody's hopeful. There's some people, there might be a few people completely passive. There might be a few people completely active, but people do a mixture of those two things. And as an industry, that's what we provide. And different sectors, and these things will go in and out of fashion as time goes by. as an active manager, you want to take advantage of things going in and out of fashion, whereas a passive manager, you make the decision, you stick with it, which is strange because it can't be the right decision all the time. Surely you should change your passive decision at some point. So how can you do something now that's appropriate for the next 40 years because you're passive? It just doesn't make sense to me. I don't get it.
And in terms of you talked about more high yield today than there's ever been. In terms of kind of the bonds that are coming to market, what do you think the future looks like? Do you think it will get a material change in the kind of currency outlook or the areas of the market that are growing? Do you see any particular trends playing out?
It's a function of what the capital's needed for. So if the industry is full of intensive capital and the cheapest ways to raise that is through the debt market, then obviously there'll be more and more debt issued to finance that. So in previous years, a classic example would be let's say the mortgage market, which is the thing that most people are familiar with in terms of entering into some kind of debt contract or owning some kind of liability or a large asset of some description. With that, it depends on the population. So if you have lots of population growth, and obviously there'll be lots of demand for mortgages and lots of building, etc. And if you have a country with less population growth, and demand for housing will be less, and so the mortgage market will be less and borrowing will be less. So you could take a classic example, would take a growing society in the emerging market with a highly growing population, let's call that India, and you take somewhere else that's got a decline in population, let's call that Japan, and you're going to have different economic scenarios, different levels of borrowing, different ways forward. So this will change over time. And the same applies to industries. So if in industry there's lots of house building, maybe house associations will be borrowing, the government might be borrowing, or if they're financing the housing, or it'll be the mortgage market, and that will drive that. But if there's no house building, then that market won't grow as much. It depends what drives it. And you get some strange secular thing, because obviously the big investment boom at the moment is more tech. And the strange thing about technology is it seems to throw off enough cash to be able to reinvest in this business plan.
Yeah.
So something like Microsoft, which is at the forefront of AI as it's reinvented itself, it's AAA rated, it's better rated than governments, it throws off lots of cash. It doesn't need to borrow to grow. Apple doesn't need to borrow to grow, it's got cash in its balance sheet. So it's quite strange, you've got a different set of things about growth that's done in a different way that we've never really seen before. So those sectors will be dominant in the equity market, where their high P multiple means their financing is cheap, but they'll tend not to issue too much in the bond market because they don't need to. But there are borrowers that will need to, and I think the big sort of change over time is the emerging markets are becoming more and more developed. It's the growth markets. They're the areas that are growing. As those areas get bigger, then their populations grow. They need to borrow money. They need to upgrade from their living standards, which generally means building and growing and doing things, developing infrastructure, developing industry, developing new technology, developing education, developing defence. So as those things happen, then you can expect the emerging market area to grow and become more important, whether they finance themselves in dollars or they finance themselves in euros or yen, wherever they finance themselves. But they'll be quite heavier borrowers, and societies that are fully developed don't need to borrow. It's a bit like a life cycle. When people tend not to borrow a great deal of money when they're very old, and they tend to borrow no money at all when they're young because nobody will lend it to them. There's obviously that part where you're growing in a family where borrowing does occur.
Yeah, plenty of opportunity ahead. Yeah,
yes,
exactly. I was going to say, right in the midst of that.
Maybe we get off that cheery topic for the two of us and get on to the final item of your vending machine, which is your dream chocolate bar.
Crunchy, yes.
There we have.
So just big again, it's one that's been around a long time. Not
Does
too
it
filling.
have any? No, that's true.
Not too filling.
Yeah.
So it's not too heavy. So it's very sweet. So it goes very well with a cup of tea.
Okay, so that would be.
So that would be.
So in the dream vending machine concept, you would have your cup of tea with this.
You would go for the free cup of tea.
Yeah.
With the crunchy.
Yeah, absolutely.
I can see that.
As opposed to having to.
And you don't dunk
go to the
crunchy in, I assume.
Oh no, I wouldn't do
good.
things like that. I've never been a dunker.
No.
Not my
Not
my way.
No.
Full disclosure, this is my favourite chocolate bar. This would be in my dream machine as well, and I'm not just saying that. I think it's one of the best chocolate bars.
I'm going to actually open mine.
I really do. Yeah, and I like the fact that you've sort of complementary items. You're thinking about how they interact with other things, and it's like portfolio.
So it's food and drink, isn't it?
It's like portfolio building.
It's food and drink. You should always think about the two together. Yeah,
indeed. Richard, thank you very much for your time. All that remains for me is to play back to you your dream vending machine items. So as your drink, you have your full fat Coke any time of day.
Yes.
In the right circumstance, obviously.
Yeah. Right.
Your salt and vinegar crisp was a compliment.
Again, pretty much.
Any time of day.
Any time of day.
Yeah, any time of day. And then...
any time of day.
On a crunchy, any time of day as well.
Yeah.
Midnight, 6 a.m. If the situation calls for it.
If the situation calls for it, you know.
A nice light crunchy.
Light crunchy, just to keep you going to the next proper bit.
Richard,
Thank you so much
very much
for joining
with us.
Thank you. Very kind.
Thank you.